2025 is still the year of transition, but the bottom is in sight. This is Tarek Morshed with the Morshed Group, bringing you the Q3 2025 commercial market update for Austin, Texas. During Q3, Austin's commercial landscape saw each sector going through a version of a reset, sending the clearest signals yet. The market is in the process of establishing its floor. Job growth remains slower, capital is still expensive, and supply from the past few years is still being absorbed. Yet the data shows a city slowly moving towards balance. Office. Signs of life at the bottom. The office market showed real movement for the first time in 2 years. Austin posted 700,000 square feet of absorption in Q3. That pulled direct vacancy to 22% from 25%. That's still far from the 12 to 14% equilibrium range, but the quarter marks the early stages of stabilization. A key opportunity? Small to mid-size office assets are running at about a 10% vacancy rate. We see great upside here. Asking rents held flat at $45 a foot across all classes, and cap rates average 6 to 7% depending on risk profile. The takeaway here is it's one of the last windows. Tenants can secure best-in-class space with great concessions, and investors can acquire quality product at prices unlikely to repeat once job growth kicks back in. Industrial, oversupply today, tailwinds tomorrow. Austin's industrial market is somewhat bloated, digesting the construction boom of the last 3 years. Q3 vacancy reached 14%, well above the 5 to 8% balanced range, driven primarily by large spec projects, accounting for the majority of that vacancy rate. Similar to the office asset class, we see opportunity in the smaller industrial spaces. Rents hovered at around $15 a foot. Construction starts have dropped substantially, which will help, and cap rates widened from about 6.5% to 7.25%. Key takeaway, the softening is short term, but there will be an oversupply for a few years while the market rebalances, meaning there's a temporary buy opportunity. Multifamily, the first meaningful stabilization. Multifamily posted its most encouraging quarter since 2021. Renters absorbed 5,600 units, while 3,700 units were delivered, pulling vacancy down some to about 14.5%. A balanced market in vacancy sits closer to 5%. But the direction here is what matters. Q3 was the first real step back towards equilibrium. Concessions remain prevalent, yet rent declines are tapering, and cap rates seem to be finally settling into the 5.5% to 6% range. The takeaway? This is likely the last buyer-friendly chapter of the cycle in multifamily for Austin. The window for value will narrow as absorption continues. Retail, Austin's most reliable performer. Retail continues to be the most stable and undersupplied sector across the MSA. Vacancy sits only at 3%, which is practically the time it takes just to turn over for the new client. And Q3 recorded a very strong 416,000 square feet of absorption. Rents held around $26 a foot plus triple net, and new projects remained heavily pre-leased, which will keep vacancy tight well into 2026. Interestingly, cap rates sit in the 6.5% to 7% range, which seems like a good value given vacancy rates. Takeaway, if you already own quality retail in the MSA, you're well positioned. If you're a buyer, buy now before rates start moving down, creating cap rate compression, which means you pay a higher price. To read the full update and get more comprehensive information, click on the link below. We're in the know at the Morshed Group, so you can make powerful decisions.